You've seen it happen. Markets are just, in free fall, prices plunging day after day. You felt the anxiety, maybe even, the panic. And then sometimes, just when the pain is almost unbearable, or maybe you're convinced, okay, we finally hit rock bottom.
Right. That hope starts creeping in.
The market bounces. And not just a little tick up, but sometimes a really significant, sharp rally. Hope flares. Is this it? Is the recovery starting?
And then, bam, crushing reality hits.
The bounce just fails, and prices resume their slide, often falling even lower than before that little temporary uptick.
Yeah.
That moment of false hope, that deceptive rally right in the middle of a brutal decline, well, it's one of the most challenging patterns to navigate in financial markets.
And it comes with a name that's quite, graphic, but undeniably memorable. The dead cat bounce.
Yeah, it sticks with you.
It really does. The term comes from that rather stark saying that even a dead cat will bounce if it falls from a great height.
Grim, but effective.
It's a vivid, maybe a bit morbid image, but it perfectly captures the essence of this whole market phenomenon. A sudden, brief rebound that isn't driven by underlying strength or, a true return to health.
No, it's just a reaction.
It's simply a reaction to a severe fall. It's often cynically called a sucker's rally or a deceptive rally, and honestly, for pretty good reason.
It really does highlight the difference between, like you said, a reaction and a real recovery. And understanding this specific pattern is absolutely crucial, especially when markets have been volatile, like we've certainly seen in U.S. stocks lately.
Oh, definitely.
But let's be clear, this isn't unique to equities, right?
Yeah.
The sources we looked at show this pattern playing out everywhere.
Pretty much everywhere, yeah. Cryptocurrencies, Forex, commodities, basically, wherever prices fall dramatically. And getting caught mistaking one of these temporary bounces for a true trend reversal, wow, that can be incredibly costly.
Huge losses.
Yeah, leading to significant losses or maybe missing the real opportunity that comes later on. And it really preys on some very natural human emotions, doesn't it? That desire to see the market recover, the urge to jump in and buy when assets seem cheap.
The fear of missing out. FOMO.
Exactly, FOMO. You want to avoid missing out on a potential bottom. These patterns kind of leverage that hope and anticipation against you.
So that's our mission today on the Deep Dive. We've really dug into a stack of material historical analyses, technical trading guides, lots of discussions among investors who've, lived through these market cycles.
Seen it happen firsthand.
And some really insightful articles breaking down the mechanics and the psychology behind it all. Yeah. We're going to distill the core insights, the essential nuggets you need to understand about the dead cat bounce.
We'll define it, dissect its characteristics, explore the underlying forces that cause it.
And crucially, grapple with why it is so notoriously difficult to identify in real time. Think of this deep dive as a kind of vet's warning, drawn from the sources, highlighting the significant risks and the sheer challenge this pattern presents, particularly for individual investors and traders trying to make sense of all the market chaos.
Right. And by the end of this deep dive, you should have a much clearer picture of this deceptive market behavior. You'll understand not just what it looks like, but why it happens and why telling it apart from a genuine bottom is such a persistent, nagging problem.
Yeah.
Armed with this knowledge, you can start to think more critically about market rallies during downturns and maybe employ some strategies discussed in the sources to potentially protect your capital and make more informed decisions when volatility strikes.
All right, let's really unpack this concept then. At its most fundamental level, what is the definition of a dead cat bounce? Can we nail that down?
The core definition, across the sources we looked at, is actually pretty consistent. A dead cat bounce is a temporary, often sharp recovery in an asset's price that happens after a significant or prolonged decline.
Okay, temporary recovery after a big fall.
Exactly. But the crucial element is that this upward move is not sustainable. It's followed by a continuation of the original downward trend, with the price eventually falling below the low point it reached before the temporary bounce even began.
So it's like a brief interruption of the fall, just a little upward blip in a much bigger slide downwards.
Precisely. And the term dead cat bounce itself, despite its, crudeness, is quite effective because it instantly conveys that idea of a rebound that lacks life or vitality.
No real pulse.
Exactly. It's not a sign of underlying health returning. It's just a physical reaction to a hard impact, like we said. And yeah, as you mentioned, it's commonly called a sucker's rally because it tends to lure unprepared buyers into a position that's likely going to deteriorate further pretty quickly.
And for those who follow technical analysis, The sources categorize this differently than a reversal, right? It's a continuation pattern.
Yes, that's a key technical distinction. Despite how it might look initially maybe resembling the start of a new upward trend charting analysis, typically views the dead cat bounce as indicating that the underlying bearish trend is still very much dominant.
The main trend is still down.
Right. The bounce is just a pause, maybe a correction. Within that larger downward movement, it actually kind of confirms the continuation of the fall once the bounce ends and rolls over.
And just to reinforce, because we touched on it, this isn't limited to stocks, is it? You'll see this across different markets.
Absolutely. The principles of market psychology and the mechanics of price movements that create this pattern apply really broadly. You can find examples in stock indices, individual company shares, bond markets.
Crypto.
Oh yeah, definitely in the volatile world of cryptocurrencies and even in foreign exchange markets. Basically, wherever there's a sharp decline, the conditions can be ripe for one of these temporary deceptive bounces.
Okay, so we know what it is, a temporary weak rally within a downtrend. How does it typically play out? Like, what are the key characteristics the sources tell us to look for in the anatomy of a dead cat bounce?
Yeah, the sources reveal a pretty specific anatomy to this pattern. It usually unfolds in like 3 stages. First, you absolutely must have a preceding event, a sharp, significant price decline.
Right.
This is the initial fall from a great height, so to speak. It's often triggered by major negative news, maybe a severe economic shock, disappointing corporate earnings, or just widespread market fear like the initial reaction to the COVID-19 pandemic back in early 2020.
So the market takes a serious hit first.
Yeah.
Got to have that big drop.
Right. Price goes down and usually goes down hard and fast.
Right.
Then comes the second stage, the temporary rebound, the bounce itself. This is where the deception really lies. The price moves upward, sometimes quite suddenly and sharply, creating this illusion of a recovery. And for investors who've just been watching their holdings plummet, this can feel like immense relief. Like, okay, finally, the light at the end of the tunnel.
And how long does this upward move typically last? Are we talking hours, days, weeks? What do the sources say?
The sources generally describe it as typically brief. If you're looking at daily charts, it might last anywhere from just a few trading days up to maybe 2 or 3 weeks, perhaps.
Not very long, then.
Not usually, no. And on shorter intraday timeframes, it could be even quicker, maybe just a few hours. The key is that it lacks longevity. It's not a sustained upward march.
Brief, sudden, looks like a recovery might be starting. And then, what's stage 3?
Then comes the third stage. The failure of that recovery and the continuation of the original trend. Basically, the buying pressure that fueled the bounce just runs out of steam, often because it wasn't based on genuine long-term conviction in the first place. Selling pressure resumes, and the price starts to fall again. And the defining characteristic, the confirmation that you get in hindsight, is when the price eventually falls below the lowest point it reached before the bounce occurred.
That's the critical point, isn't it? You only really know for sure it was a dead cat bounce once the price sinks lower than that previous bottom.
Exactly. And that's what fundamentally differentiates it from a true trend reversal. A genuine recovery, it's typically characterized by more sustained buying interest, broader participation of buyers, usually improving fundamental conditions for the asset or the market.
Real reasons for it to go up.
Yeah, and the ability to break through and hold up significant resistance levels. A dead cat bounce lacks that depth and conviction. It usually hits resistance and just folds.
Okay, so initial sharp fall, brief deceptive bounce, then the price continues the fall below the previous low. That structural sequence makes sense. But let's dig deeper into why this happens. What are the underlying forces that actually create these temporary rallies right in the middle of a collapse?
The sources point to several drivers, right? They do. And understanding the causes really helps explain why these bounces lack staying power. One major driver the sources highlight is short covering.
Okay, let's break down short covering a bit. It's related to people betting prices will fall, the short sellers.
Yes, exactly. Short selling is a strategy where a trader borrows shares, or maybe another asset, sells them on the open market, expecting the price will decline.
Hoping it goes down.
Right. If the price falls like they expected, they buy the shares back at that lower price, return the borrowed shares to the lender, and pocket the difference as profit. Short covering is simply the act of buying those shares back to close out that short position.
Got it.
So when a market or an asset has plummeted really quickly and severely, those short sellers who made profits on the way down will often start buying back shares just to lock in those gains. This wave of buying, even though it's just to close existing positions, can create sudden upward pressure on the price.
So it's not necessarily new buyers coming in because they suddenly believe in the asset's future, but people who were betting against it are now forced to buy back to take their profits or cut their losses.
Precisely. It's often kind of mechanical buying or maybe risk management buying by short sellers who are getting nervous about a temporary bounce erasing their gains. It's generally not conviction buying based on a belief in a fundamental turnaround, and that's a key difference from a true recovery.
Okay.
Another factor is speculative buying, often fueled by what looks like a market overreaction or just plain false assumptions.
This sounds like the classic buying on the dip scenario we hear so much about. People trying to catch a falling knife.
It is, in part, yeah. After a sharp fall, some investors look at the new lower price and they perceive the asset as oversold, or maybe they just believe it must be near its bottom.
Just a gut feeling sometimes.
Could be. So they step in and buy, hoping to capitalize on what they think is an imminent rebound. Their buying, driven by this belief, which might be premature or just plain wrong, adds to the temporary demand and pushes prices up, creating that bounce that other people then might mistake for a true bottom starting.
So it feeds on itself a little bit.
It can be a bit of a self-fulfilling prophecy, but one built on pretty shaky ground, usually.
So the collective actions of investors trying to time the bottom, sometimes, getting it wrong, actually contribute to this temporary rally.
Exactly. And this can be amplified by a sense of false optimism or maybe triggers from technical indicators, sometimes even relatively minor positive news, a circulating rumor, or the price simply hitting a perceived technical support level on a chart.
Like a line someone drew.
Yeah, or a moving average. That can trigger automatic buy orders, perhaps from algorithmic trading systems, or it might just encourage manual buyers who watch those levels. This creates a brief wave of buying interest and the illusion of a sustained recovery, even if the fundamental picture hasn't actually changed one bit.
It's like any small spark can ignite a temporary fire in really dry conditions.
That's a good analogy. And these bounces often occur during periods characterized by low liquidity, meaning fewer buyers and sellers actively trading, combined with high volatility. In such thin, nervous markets, even relatively small amounts of buying pressure, like that coordinated short covering or a burst of speculative buying, can have a disproportionately large and rapid impact on prices, creating that sharp upward spike.
So fewer people trading means any buying activity, however small or fleeting, can move the price really dramatically.
Yes. And the crucial point the sources really hammer home is that these underlying causes, the short covering, the speculative dip buying based on assumptions, the reactions to minor triggers are often not indicative of any fundamental improvement in the asset itself or the broader economic conditions that caused the initial decline in the first place.
And that lack of fundamental support is precisely why the bounce is ultimately destined to fail.
Yeah.
It doesn't have legs.
Precisely. The rally isn't built on a solid foundation of improved earnings or a better economic outlook or a change in the core reasons the asset was falling. It's based on temporary market mechanics and psychology, which is why it typically runs out of steam and the dominant downward trend just resumes.
This leads us beautifully into the human side of this pattern, the whole psychology aspect. The sources describe this as a kind of trap, particularly for individual investors, right?
Oh, the psychology is absolutely central to the dead cat bounces danger. It really is. The sources highlight that these patterns can, sometimes maybe even intentionally by larger players, act as significant traps, especially for retail traders.
How does that trap actually manifest? What does it look like?
Well, think about it. After enduring potentially steep losses during that initial sharp decline, individual investors often feel immense relief and, hope when they see prices start to rise during the bounce. They want it to be the bottom. Desperately. They fear missing out on the recovery that FOMO kicks in again, and they're eager to recoup losses or just get back into the market at what seems like a discounted price. So they buy into this temporary bounce, desperately hoping it's the start of the real recovery.
Only to get burned again.
Only to be caught as the price falls again, often to new lows.
It's that desire to call the bottom or maybe average down, fueled by hope and maybe the pain of recent losses.
Exactly. And this is often contrasted in the sources with the behavior of larger institutional investors.
Yeah.
Sometimes called big money or smart money.
Right.
These players typically have deeper research capabilities and, frankly, greater patience. They are generally less likely to jump in on the very first sign of a bounce. They often wait for stronger, more fundamental confirmation signals, perhaps a significant shift in economic data, a clear improvement in a company's prospects, or maybe just waiting for the price to fall to a level they've identified through rigorous analysis as the true intrinsic value or potential market bottom.
So while the individual investor might be reacting more emotionally to the bounce itself, the institutions are often waiting for more objective evidence before committing capital.
That's the dynamic often described, yes. And repeatedly falling for these false rallies, it takes a massive psychological toll. The sources don't shy away from this. They use phrases like soul-crushing to describe the experience.
I can imagine.
Experiencing hope followed by renewed losses again and again can lead to serious emotional fatigue. It erodes confidence and can potentially lead to impulsive, fearful, or just irrational trading decisions later on, maybe causing them to finally give up and sell near the actual bottom out of sheer exhaustion.
Wow.
This psychological aspect is a huge part of that VETS warning. We mentioned it's not just a technical challenge on a chart, it's a profound test of an investor's emotional discipline and patience.
So if it's such a psychological minefield and so incredibly deceptive, how can investors or traders even attempt to identify a potential dead cat bounce in real time? Because the sources are pretty clear, this is the hardest part. Maybe impossible sometimes.
They are very clear and very direct on this point. The most significant limitation, the kind of brutal truth the sources lay bare, is that a dead cat bounce is most reliably identified only after it has already occurred.
Only in hindsight.
Only in hindsight, meaning you can be truly certain after the price has resumed its downward trend and fallen below the lowest point it reached before the bounce. Identifying it in the moment as it's happening is extremely difficult, even for seasoned pros.
Okay, so hindsight is 20/20, we get that. But what tools or signals do the sources suggest traders look at to maybe increase their odds of recognizing a potential dead cat bounce while it's unfolding, even acknowledging the inherent difficulty?
They point to several technical indicators and analysis techniques while consistently stressing that none are foolproof on their own, especially not for predicting this specific tricky pattern. One of the most critical signals mentioned again and again is volume analysis.
Okay, how does trading volume factor in here? What are we looking for?
A key characteristic, often cited, is that the temporary rebound phase of a dead cat bounce typically occurs on low trading volume compared to the much higher volume seen during the initial sharp decline. This is a significant clue. Low volume during the bounce suggests that the upward move doesn't have broad participation or real conviction from many buyers. It might just be that short covering we talked about, or limited speculative activity. It lacks the widespread buying interest needed for a sustained recovery.
So the price is going up, but the underlying activity, the sort of strength or oomph behind the move, just isn't there. It's like a weak pulse.
Exactly. It's an upward move that lacks substance. Conversely, the subsequent drop after the bounce often occurs on increasing volume, which tends to confirm renewed selling pressure and conviction in the continuing downward trend.
Okay, low volume on the bounce, high volume on the way down. Makes sense. What else?
Another technique involves watching resistance levels very closely.
These are those price points where upward movement tends to stall out, right?
Yeah.
Like a ceiling.
Yes, exactly. During a potential dead cat bounce, the price will typically struggle to break decisively above significant resistance levels. These could be prior support levels that have now flipped and act as overhead resistance, key moving averages like the 50-day or 200-day, or maybe the last swing high that was established within the existing downtrend.
Right.
A bounce that hits these levels and then clearly fails to move convincingly higher is a strong bearish sign. It indicates the upward momentum is weak and likely just temporary.
And those moving averages themselves can act as resistance or just signal that the dominant trend is still down?
Absolutely. If the asset's price remains well below key longer-term moving averages, the 50-day or the 200-day simple moving average are common ones, it strongly suggests the overall longer-term downtrend remains firmly intact, regardless of some short-term bounce.
Okay.
And a bearish crossover, like when the 50-day moving average crosses below the 200-day, often called a death cross, is another reinforcing signal of dominant bearish momentum in the background.
What about momentum indicators? Things like RSI or MESID that measure the speed and strength of price movements. Do they offer clues?
Yes, the sources mention using momentum oscillators like the RSI, Relative Strength Index, MESID, Moving Average Convergence Divergence, the stochastic oscillator, or maybe the awesome oscillator. Now, while these indicators can definitely show that prices are oversold after a sharp drop, which might suggest a bounce is possible.
Right, they signal maybe it's gone too far too fast.
Exactly. But they can also provide clues during the bounce itself. For instance, if the bounce occurs but the RSI fails to convincingly rise back above the 50 level, which is often considered the midpoint between bullish and bearish momentum,
Okay.
or if the MACD histogram stays stubbornly in negative territory, or maybe shows a bearish crossover during the bounce, these can signal underlying weakness and a real lack of buying conviction, despite the price going up.
But there's a warning with these too, right? That they can sometimes give false bullish signals right at the start of a bounce.
Yes, that's absolutely critical to remember. Because the bounce itself is often a rapid upward move, indicators like RSI might quickly pop up from oversold levels, or MTD might show a temporary bullish cross, simply reflecting the speed of the price change, not necessarily sustained underlying strength.
So don't rely on just one thing.
Absolutely not. That's why reliance on a single indicator is so dangerous here. You really need to look for confluence, multiple indicators, and techniques aligning to tell the same story. The sources specifically mention watching for something called bearish hidden divergence.
Okay, what's that? Sounds complicated.
It's a slightly more advanced concept and a bit counterintuitive, perhaps. It's when, while the price on the chart might actually make a higher low during the bounce phase.
Which sounds good.
Right, sounds bullish. But the indicator, like RSI or MTD, fails to make a higher low. It makes a lower low. This suggests the underlying momentum is actually weakening, even as the price ticks up slightly. It's a bearish sign kind of hidden beneath the surface price action.
Okay, so it's about looking for clues that this bounce is different from a true recovery, that it lacks broad participation, low volume, it struggles at key levels, resistance, and underlying momentum indicators show weakness, not strength, maybe even that hidden divergence.
Precisely. Other techniques mentioned include looking at broader price patterns and reinforcing the analysis with classic support and resistance lines. But ultimately, as we keep saying, the most definitive confirmation is when the price breaks below the previous bottom. That confirms the bounce was temporary and the downtrend has resumed.
Got it.
Some sources even touch on less direct measures, like tracking the volume of short interest, trying to gauge sentiment, though this is presented as a less immediate technical signal than chart patterns and volume analysis.
But let's just reiterate the core difficulty one more time, because the sources are incredibly honest about this and it's worth repeating.
Yes, the fundamental challenge cannot be overstated. Even highly skilled traders, analysts, institutional investors, they routinely mistake dead cat bounces for true reversals in the moment. And why?
Why is it so hard?
Because the early stages of a genuine market bottom and the subsequent recovery also often feature very strong, sharp initial gains as buyers finally step in with conviction. This makes telling the difference in real time incredibly difficult. You're looking at two things that initially look very, very similar, and the only truly reliable way to differentiate them comes with hindsight, after the market has already moved significantly one way or the other.
It's a classic market puzzle where the most definitive answer arrives too late to be really actionable in the moment you need it most. So, okay, if it's so hard to spot, how can traders and investors actually use this knowledge? What strategies do the sources suggest for navigating this treacherous pattern?
Well, for experienced traders who are comfortable with it and are potentially betting on prices falling further, the short sellers we talked about, the dead cat bounce, can maybe paradoxically present a potential short selling opportunity.
Okay, so instead of being tricked into buying the bounce, you might actually use the bounce to get a better price to sell short. Is that the idea?
Exactly. The strategy here is kind of counterintuitive for someone looking to buy, but it's definitely highlighted in the sources. Instead of being fooled by the bounce, these traders wait for it to happen, let the price rise temporarily, and then they initiate a short position once they see those signs we discussed indicating the bounce is likely failing.
Like the low volume failure at resistance.
Exactly. Low volume on the rally, hitting and failing at resistance, maybe seeing specific bearish candlestick patterns form, weakening momentum indicators. The idea is to short the asset at a relatively higher price before the expected next leg down of the original trend resumes.
But attempting to short into a potential bounce sounds incredibly risky. What if you're wrong, and it actually is a real recovery this time?
It is risky, absolutely, which is precisely why the sources place enormous emphasis on risk management in this scenario, particularly the non-negotiable use of stop loss orders.
Got to have your exit plan.
You absolutely must. If you're attempting to short a suspected dead cat bounce, you would place a stop loss order just above the significant resistance level the price failed to break through, or maybe just above the recent high point of the bounce itself. This is absolutely crucial to limit your potential losses if the price defies expectations and continues to rise, indicating it was actually a true recovery and not a dead cat bounce after all.
So you define your maximum potential loss before you even enter the trade. Makes sense. Where would you look to take profits if the pattern plays out as expected and the price does fall again?
Potential profit targets for that short position could be the next significant support level below the previous low. Or maybe traders use technical methods like projecting the length of the initial sharp decline downwards from the peak of the bounce. The basic goal is to ride the continuation of the downtrend that follows the failed bounce.
Okay, that's one angle, trying to trade the continuation down. What about for investors whose primary goal is maybe the opposite? They want to buy low during a downturn to get into the market when things seem cheaper. How do they avoid getting caught in the dead cat bounce trap?
For buyers, the overriding strategy derived from the sources is patience. Simple, but hard to do. It's all about avoiding buying too early without strong, convincing confirmation of a true trend reversal. You have to resist that urge to jump in just because prices are ticking up for a day or two after a big fall.
So don't just buy the dip, you need to verify the dip first.
Exactly. Verify the dip. Use that whole array of indicators and techniques we discussed: volume, resistance, moving averages, momentum signals, but use them collectively, looking for confluence to confirm the strength and conviction of any upward move rather than just reacting to the temporary price increase itself. Don't put all your faith in just one signal lighting up green.
And fundamental analysis plays a key role here too, right? It's not just about looking at charts.
Absolutely. The sources strongly recommend combining fundamental analysis with technical charting. Before you even think about buying, you need to assess why the asset fell so hard in the first place. Was it due to temporary, perhaps fixable issues, or are there deeper, more systemic problems?
Right.
If the fundamental issues that caused the initial decline remain unresolved, any bounce is highly likely to be temporary. A true sustainable recovery needs improving fundamentals to actually support it. So yeah, look beyond the price action and understand the actual health and prospects of the underlying asset or market you're considering.
Understand what you're buying, not just the shape of its price chart on the screen.
Precisely. Now, some traders, taking a very, very cautious approach, actually wait for pattern confirmation after the fact. They might literally wait for the price to drop below the previous low to confirm that the earlier bounce was indeed a dead cat bounce before taking any action.
That seems really late, though.
It might mean taking a later, less optimal short position if that's their game. Or perhaps more commonly, for someone who maybe bought the bounce and was wrong, it means cutting their losses decisively once the bounce is confirmed to have failed by the price sinking below that prior bottom. It's about damage control at that point.
Okay, what if someone realizes they have been caught, they bought into the bounce, maybe got hopeful, and now the price is turning back down? What does the source material suggest in terms of managing that kind of situation?
Yeah, if you find yourself in that difficult position, the sources really emphasize risk management techniques again, mostly to limit further damage. The most crucial is probably the cut loss strategy.
Just get out.
Pretty much. This means selling your position if the price falls below a predefined support level or hits your stop loss point that you hopefully set beforehand. It's about accepting a smaller loss now to avoid potentially much larger ones if the downtrend really accelerates.
It takes discipline to admit a mistake and get out, especially in a loss. But it preserves capital for the next opportunity.
It's absolutely essential for long-term survival in the markets. Another strategy mentioned, though maybe less ideal, is if you miss the opportunity to short or sell near the peak of the bounce, you might look to sell at resistance during any subsequent minor bounces within the continuing downtrend.
Using little relief rallies to exit.
Right, using those small rallies as opportunities to exit at a slightly better price than just selling into a free fall. The sources also discuss averaging down, buying more shares at lower prices to reduce your average purchase cost. However, they explicitly label this as a very risky strategy.
Yeah, I bet.
It's only really advisable if you have extremely high conviction, based on deep, thorough analysis, that the true bottom is imminent and a sustained rebound is highly probable. Otherwise, you're just throwing good money after bad.
That really reinforces the whole vet's warning element, doesn't it? Averaging down into a potential dead cat bounce based purely on hope is probably a fast track to compounding your losses significantly.
Exactly. It's a maneuver fraught with peril unless executed with deep conviction, born of rigorous analysis and very careful position sizing. The sources also briefly touch on the mirror image of the dead cat bounce, sometimes called an inverted dead cat bounce, or maybe more commonly, a bull trap.
Okay, what does that look like? How does that work?
That's when you have a sharp temporary drop in price. But it happens within an otherwise bullish upward trend.
Okay, so the main trend is up, but there's a sudden dip.
Right. The sudden dip can trick bearish traders into thinking the uptrend is finally over, so they initiate short positions, betting on further decline. However, the drop turns out to be temporary. The price quickly recovers, and the original uptrend continues, leaving those poor short sellers trapped in losing positions as the market keeps rising against them.
So for investors who are generally bullish and maybe already long in a market, this inverted pattern, this sharp dip within an established uptrend, might actually be seen as a buying opportunity, if other indicators confirm the overarching bull trend is still strong.
Correct. If the price holds above key support levels during that dip, if momentum indicators remain generally bullish, and the fundamental outlook is still positive, then that temporary dip can be seen as a chance for long traders to add to their positions at a better price. Whereas for someone trying to short the market, it was a deceptive trap. It's basically the same psychological and mechanical principle as the dead cat bounce, just flipped vertically on the chart.
Okay, this is all making sense conceptually. Let's try to anchor this with some real-world examples from the sources.
Yeah.
History must be just littered with instances of these deceptive rallies. Right?
Oh, history provides some incredibly powerful and sometimes, pretty painful illustrations of this. The Great Depression stock market crash is perhaps the most extreme historical example featuring significant dead cat bounces.
How did that unfold after the initial crash in 29? Wasn't there a big rally soon after?
There was. After an initial drop of about 45%, the market experienced a massive rally, about 47%, stretching from late 1929 into early 1930.
Wow, 47%.
Yeah, imagine the sense of relief and the feeling that the recovery was underway that rally must have created. But, as the sources chillingly note, it was entirely fleeting. Following that nearly 50% gain, the market would go on to fall by a staggering additional 80% from its 1929 peak before it finally bottomed years later.
An almost 50% rally was just a bounce in a much, much larger, devastating decline. That really highlights the potential scale of deception here.
It's a truly stark reminder. And the sources point out that this period wasn't just one bounce. The Great Depression bear market included numerous significant rallies all along the way, down things like monthly gains of 8%, 9%, 12%, 14%, and even larger bounces of 23%, 27%, and 35%.
Wow.
Each one, a false dawn, a moment of hope before the relentless decline resumed. It's described as a soul-crushing crash precisely because of these repeated cycles of false hope followed by renewed pain.
Multiple substantial bounces within one prolonged massive collapse. That really drives home the point that bear markets are rarely just straight lines down. They zig and zag.
They are definitely choppy and deceptive. Other historical examples cited in the material include the 1973-1974 bear market. The market was eventually cut in half from its peak then, but not before featuring a notable 20% bounce that ultimately failed.
Okay.
And the 2007-2009 financial crisis bear market also saw a rally of over 25% that was eventually given back completely before the true bottom finally arrived in March 2009.
And didn't many economists and analysts actually call the start of that big rally in March 2009 a potential dead cat bounce at the time? Weren't they expecting new lows?
They absolutely did, and that's another perfect illustration of the extreme difficulty of real-time identification. Even seasoned experts were very wary, thinking that initial strong bounce off the lows in March 2009 might just be another temporary rally in a continuing downtrend. It turned out, only in hindsight, to be the actual bottom, but it highlights that the early stages of a genuine recovery look incredibly similar to a dead cat bounce. That initial burst of buying is present in both scenarios.
Okay, what about the 2000-2002 dot-com crash? That must have had some too.
Oh yeah, That period is noted for featuring 3 separate rallies, each one around 20%, occurring before the market finally found its bottom more than 50% below its peak.
3 distinct fakeouts.
Pretty much. The sources use Cisco Systems as a specific company example from that era. The stock peaked way up around $82 in March 2000, then fell dramatically, hitting lows around $15.81 by March 2001. It then saw bounces, like one that took it back up to $20.44 by November 2001.
Giving hope.
Giving hope, exactly. But these were temporary. The stock continued its decline, eventually falling all the way down to $10.48 by September 2002, and it traded significantly lower for years after that peak.
Another clear multi-year example of significant but ultimately temporary rallies happening within a prolonged and really deep bear market.
And a more recent example, which was referenced across several sources, is the initial market reaction to the COVID-19 pandemic back in spring 2020.
Oh yeah, it felt incredibly fast and brutal at the time.
It was. The U.S. market experienced a very sharp decline, roughly 12% in just 1 week in late February 2020, as the reality of the pandemic's potential impact really began to sink in.
Right.
The very next week, the market saw a bit of a rally, about 2%. Now, for some, just seeing green on the screen after such a rapid fall felt like maybe, just maybe, the start of a recovery.
A sigh of relief.
Exactly. But the sources classify the small 2% gain as a classic, though small-scale, dead cat bounce, because right after that, the market plunged an additional 25% over the subsequent 2 weeks before the true, sustained recovery began much later in the summer of 2020.
That's a perfect recent illustration.
Yeah.
Sharp drop, brief deceptive bounce, then a continuation of the fall to significantly lower lows before the real turnaround finally happened. These historical examples really underscore how common these bounces are during bear markets, and crucially, how substantial they can sometimes be, making the deception very convincing in the moment.
They serve as powerful lessons that patience and caution are really paramount when you're trying to navigate market downturns. Waiting for strong, undeniable confirmation of a trend change is often far wiser and safer than reacting impulsively to the first sign of an upward movement.
So pulling all this together then, the core message from these sources seems to be less about having some kind of magical formula to predict the market's every twist and turn.
Which doesn't exist.
Right. And much more about acknowledging the inherent uncertainty and focusing really hard on robust risk management and maintaining the right mindset through it all.
Absolutely. Given the profound difficulty, maybe impossibility sometimes, of distinguishing a dead cat bounce from a true bottom while it's actually happening, the emphasis shifts entirely to controlling what you can control, which is your risk and your reactions.
What are the absolute key risk management strategies the sources highlight that investors should really take away from this discussion?
As we've stressed a few times now, always using stop-loss orders is presented as pretty much non-negotiable, especially if you are attempting to trade during volatile downturns or maybe trying to buy into a potential bounce.
Your safety net.
It's your primary tool to limit potential losses if that upward move proves temporary and the price continues its descent. It protects your precious capital.
It's your predefined exit strategy. Okay, what else?
Rigorous position sizing. Super important. Don't put a large percentage of your capital at risk on any single trade or prediction, particularly when market patterns are ambiguous like this. Smaller position sizes mean that if you do get caught in a dead cat bounce, the resulting loss is manageable and doesn't cripple your overall portfolio.
Makes sense.
And as we discussed, patiently waiting for confirmation signals from multiple indicators and analysis techniques before making a significant trading decision. Don't let hope or just a single green candle on the chart dictate your actions.
Use a confluence of evidence, not just one signal flash and go.
Right. Diversification is also mentioned, of course, as a foundational risk management tool. Spreading your investments across different sectors, asset classes, maybe geographical regions, reduces your exposure to a potential dead cat bounce, or really any other single negative event in one specific area. If one part of your portfolio is experiencing a dead cat bounce, the losses might hopefully be cushioned by performance elsewhere.
Don't put all your eggs in one bouncing basket.
Yeah, exactly. And integrating fundamental analysis with technical insights, don't rely on chart patterns alone. Understand the intrinsic health and future prospects of the asset you are considering buying or selling.
Look at the engine, not just the dashboard lights blinking.
Precisely. And finally, perhaps most importantly, the mindset. The sources repeatedly underscore the psychological challenge and the absolute need for discipline. They emphasize the importance of patience, discipline, and maintaining a clear-eyed assessment of market conditions, which really just means avoiding letting fear or greed cloud your judgment.
Easier said than done sometimes.
Oh, absolutely. One source offers a piece of advice that I thought resonated deeply in this context: going long humility and short hubris.
Going long humility and short hubris, that's powerful. It speaks directly to the danger of overconfidence during these really uncertain market periods.
It really captures the essence of the challenge, I think. Believing you can infallibly time the market, perfectly call the bottom, or instantly distinguish a dead cat bounce from a true reversal based on a gut feeling or just one indicator, that's hubris. Embracing humility means acknowledging the market's inherent uncertainty, respecting the difficulty of real-time analysis, and prioritizing disciplined risk management over trying to be the hero who perfectly nails the bottom. It's a much more realistic and ultimately more sustainable approach to navigating volatile markets.
Okay, so to bring it all together, the dead cat bounce is this distinct pattern, a temporary deceptive rally following a sharp decline. It's often driven by mechanical factors like short covering or premature speculation, usually lacks fundamental support, and critically, it's only reliably confirmed in hindsight when the price falls below the previous low. Identifying it in real time is extremely difficult, requiring careful analysis of volume, resistance levels, momentum, and looking for a confluence of other signals, alongside good old fundamental research.
Yeah, that sums it up well.
And navigating this pattern successfully really means prioritizing disciplined risk management above all else, using stop losses, managing position size carefully, being patient, waiting for confirmation, diversifying, and maintaining a humble, clear-eyed mindset.
It is a profound reminder that just buying on the dip without thorough analysis and confirmation is absolutely fraught with risk, and that a cautious, patient approach often proves to be the wiser path during turbulent market times.
So maybe a final thought for you to ponder. Given how incredibly difficult it is to distinguish a dead cat bounce from the start of a true market bottom in the moment, perhaps the most valuable lesson here isn't really about trying to perfectly predict the market's next move.
Which is probably impossible anyway.
Right. But maybe it's more about embracing the uncertainty, accepting that you won't always get it right, and focusing relentlessly on disciplined risk management and emotional control to protect your capital no matter what the market throws at you next.
That disciplined humility might just be the most powerful tool an investor has in their arsenal when faced with the deceptive patterns of a falling market.
Ponder that as you look at the charts and hear the news. Thanks for diving deep with us today on this.
Always a pleasure to explore these market dynamics. It's fascinating stuff.
We'll be back next time with another deep dive into a topic designed to help you cut through the noise and get straight to the essential, actionable insights. Until then, stay informed, stay disciplined, and stay humble out there.